we at the bottom of the market?
No, not yet, but we're getting close. We're fibrillulating right now, trying to figure out what the earnings next year are going to look like. And so every time you have a rally like this, we've had an extended rally, multiple days now to the upside, it's because the belief in the market is that the Fed is finally going to slow after this next 75 basis points and kind of wait and see what happens. We got a little signal from that up in the Canadian market where they decided not to increase the sort of broadcast amount. They went 50 basis points instead of 75, showing an idea of moderation, if you want to call it that. Now, normally we do not take signals from other countries, but Canada, being the giant trading partner it is, just north of the border, it's the first time in decades I've ever seen anybody wake up and look at what the Bank of Canada was doing, and that's what happened this week. And it actually forwarded this theory, this philosophy that maybe the Fed is going to pause.
Kevin O'Leary believes that the bottom is not yet in for markets, but the end is in sight. In his latest interview, Kevin O'Leary explains why despite the massive sell-off we've seen in equity and crypto markets, there is still more pain to come and leverage to flush out of the system, but that the end of the downward cycle is close. He believes that now is the beginning of the pivot of monetary policy for the Federal Reserve, with a lower rate of increase for interest rates coming in December, with more easing to come in 2023. Make sure to stick around to the end of the video where O'Leary lays out exactly how he sees the recovery to take place next year. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
You have to remember the most hated man on earth is always the chair of the Fed, regardless of who they are, man or woman. Everybody hates the Fed. Everybody second-guesses the Fed. Everybody says they're doing the wrong thing all of the time. You can't make anybody happy when you're the Fed chair. And that's exactly what's happening here. He's trying to, in this case, in Powell's case, engineer a soft landing, which is near impossible. No one's ever seen that happen. However, data coming out this morning proves that we are not yet in a recession. Everybody kind of knows that just by the feeling of the consumer being so strong. And so for the first time in a long time, people are thinking, wow, maybe he can pull this off, and we would know sometime in Q2 next year that he could actually bring in a soft landing, slow down inflation. After all he needs, the Fed in aggregate needs, the board itself needs, is some indication that the rate of increase of inflation is slowing. That's the key right now. And so we don't have that quite yet. There's a narrative in the market, and I want people to understand this and how CPI data is gathered. So much, 40% of CPI data is housing, shelter. And shelter is a very slow index, and so it takes up to 18 months to actually have an effect on it. But people in different markets are starting to see rent rates slow or flatten or housing prices flatten. So really what we're probably doing in the CPI number right now is over-reporting inflation. And that narrative has been coming in with Professor Siegel, who's been talking about this ad nauseum for the last 6 weeks. But he has a point. You can't deny the fact that 40% of CPI is shelter. And maybe we're over-calculating it. Now, people do this all the time, and I'm guilty of it right now, trying to say, well, here's why we shouldn't believe this number. It's just more Fed beating and more Fed hating and more telling the Fed what to do. And the truth is, they don't give a damn. They don't listen. They have their own mandate. They're going to do what they're going to do. And I say that'll be 75 basis points coming to a theater near you in the next few days. Normally, portfolio theory would say this: no more than 20% in any one sector, no more than 5% in any one position. That has been a standard in the indexing market for sovereign wealth and pension plans for 100 years. And I abide by those rules in most of the mandates that I'm involved in managing, with the exception of real estate. In our operating company, our holdings in real estate now are at 39%, which is significantly, it's a heavy overweighting. And the majority of that is in Florida, where we are very positive and constructive about the demographics that are occurring there. Now, I've heard all the arguments about Miami sinking underwater, and I get all that. We've been talking about that for 100 years, and there is always that risk in any coastal investment. But when you look at the demographics and demand for properties and office properties in South Beach or Miami proper or Brickell or even Palm Beach or other West Palm Beach and other areas where I am an investor, we see this continuing on an ongoing basis. And I have to thank the politicians in New York and Massachusetts and California for this wonderful investment opportunity, because this is why prices there have not corrected and why they continue to be very, very buoyant and demand remains strong. The harder you make it to start a business in New York, the better it is for me in Miami. And so, that's the bottom line. And I talk to Mayor Suarez every day and all the other politicians there. They are very open to business. They understand the advantage they have. They're running around the world with their arms open. And on top of all that, we've got the crypto community, which some people think is going to be the 12th sector of the economy in a decade, and I agree with that theory. Centered, one of the global centers now is Miami. So I spend about 5-6 months a year there just dealing in that sector. We haven't seen a 15% correction in any markets yet. There's fundamental demand, obviously, and the consumer remains buoyant. But you're right, we could have that. Traditionally, the real estate cycle used to be 7 years. That has gone, we haven't had a significant correction, I don't care what market in North America you look at, for 25 years, and that's because of change in demographic and demand for housing, both rental and assumed ownership. But you got to look at it this way. Real estate cycles are really interest rate sensitive, as you've detailed, but these mortgage rates right now are still traditionally very low if you go over a 40-50 year period. I've been an investor in real estate when interest rates were 15%, 1.5. I've been an investor when mortgage rates were under 4. And so at the end of the day, fundamental shelter and housing and office space and demand, industrial demand for real estate remains a constant in any economy at different levels of trajectory. But as an asset class, it has proven to be buoyant for hundreds of years. The old adage, they stopped making it a long time ago. Particularly that applies to beachfront properties and vacation properties, and look what's happened in Montana. Look what's happened in North Dakota. Look what's happened to farmland. These are all investments that I look at every day. Each of them have their own merits or risks. There's no question about it. But at the end of the day, it's a fundamental building block in anybody's portfolio. And the only decision you have to make when you're young is how much debt do I want to take on? And that's governed by the percentage of that mortgage. And so you're right, if mortgage rates go past 7%, and I think the terminal rate on the Fed will be under 5, so you could see some high-risk mortgages at 7. That's still traditionally not a very high mortgage rate. When you think about an asset class like real estate, it is a very slow turn asset class. The entry and exit fees are very high. You don't flip it, you don't trade it. You really have to think about the cap rate is reflecting. And what I would agree with your statement in 2008 with the financial crisis was cap rates went up. And so it's the inverse. So if you buy a building at 4.5% cap rate, which was AAA office towers in Boston in 2008, yeah, they spiked up a bit for that 18 months, but there were very few trades in that market. So, these assets people think very long term on. Now, I would agree there's a new reason to consider cap rates going up in industrial and commercial real estate. That's because of new trend in work environments, which are not so focused on office anymore. For most companies now, they have flexibility, and up to a third or half of their employees never come back to the office. And that's probably permanent, particularly in sectors like technology. So that may put some pressure on cap rates for commercial, which means their values go down. If cap rates go up, the building's worth less. However, in the case of residential, the inverse is true, because all of a sudden you've got rural communities like Champaign, Urbana, and places where people want to live, raise their kids, go to good schools, get more house for the dollar. Those cap rates, or the cost of those houses, have gone up, and the cap rates have gone down, because all of a sudden you don't have to live in Chicago. You can live in Champaign, Urbana, and the lifestyle there on Greencroft Avenue, right on the golf course where I used to live a long time ago, that's a beautiful place to raise a family. And you can still participate in the Chicago community.